I'm Brian Beaulieu. Welcome to this edition of FedWatch. Today is August 18th, 2023, and we're all waiting to find out what the Fed does in September and again in November in terms of additional rate hikes. And some of that is going to be dependent upon the strength of the economy. And that always becomes something of a subjective point of view for a lot of people. We just look at the math. And this is a good news, bad news type situation. Total industrial production in the United States, which is available monthly instead of quarterly. The 12-month moving average, either seasonally adjusted or not seasonally adjusted, is in decline. The decline so far in that 12-month moving average is on the upper side majority range of what we'd expect to see. And so the good news is it's not diving. It's following the track that we thought it was going to be following. I think it's probably 2 months. It started 2 months sooner than the official forecast. But starting off this mild is not likely to all of a sudden become a really bad downturn. So the Feds can see some weakening if they want to. The next thing they're probably going to be waiting for would be, the jobs reports and how we are doing in that regard. This has been a really strange time. And what makes it so strange is that we're still dealing with the aftermath of COVID in terms of the government's response to that, the Federal Reserve's response to that. And we're still getting whipsawed around and getting fuzzy signals. U.S. industrial production tends to be a clear signal from our perspective. You don't get many false readings out of that. So the weakening there and the fact that the 312 is running about minus 0.4%. So that means the last quarter of data, which would be May, June, and July, was down 0.4%. And that trend is in phase D. In other words, it's still heading down through the July latest available data. Another new piece of data that came out in this past week is housing. And there we're getting what looked to us to be real green shoots in the rates of change. It is turning around in terms of permitting for single family homes. That is also turning around. Now, all those rates of change are still negative, but the 312 for housing starts is at minus 0.6% and in phase A, which means it's getting closer and closer to breaking into positive numbers. And for permits, the 312 is at minus 3.3, and that's also a phase A. And that's a heck of a lot better than the 1212, which is minus 21.0. So that's a very clear technical signal for us that we're getting close to the bottom of the declining trend. Existing home sales are going to be harder to fix because that inventory is so low right now. It's mind-blowing how low it is. Existing inventory is down 6.7% from this time last year, and this time last year was nothing to write home about. Home sales, therefore, for existing homes, running weak, but it's a chicken and egg thing. Is it because there's a lack of inventory? Is it because there's a lack of desire? Alan and I think that we're on track for consumers becoming normalized to these higher mortgage rates, which, as of this morning, was the highest we'd seen in 20 years. And some of the sticker shock is probably wearing off. I think we're on track for that late 2023 touchdown low in the 12-month moving total for housing. And we're going to be in a gradual climb out in 2024. And it will continue in 2025. So U.S. industrial production clearly negative, housing turning around in the other direction, beginning to establish a cyclical low, which is good news. It looks to be a valid green shoot. The bad news is, and I know you hate it when the economist says good news, bad news, the correlation between housing and U.S. industrial production is not that strong. Everybody assumes it's this quintessential leading indicator, but it is like a class C leading indicator. But right now, when we're looking for when we can expect the economy to generally strengthen again, it's worthwhile keeping track of housing starts and single family housing permits. My concern is the Fed's going to see housing resiliency as a reason to boost rates one more time. Whether they'll do it in September or November, I think is a 50-50 crapshoot. But I expect they are going to have one more hike, 25 bips, and then it'll be over with, and we'll be in that part of the yield curve situation where we need to see that yield curve normalize pretty quickly. And as I mentioned last week, the Fed has built in some decline in the Fed funds rate in 2024 and in 2025. It's just the timing of that GDP, US industrial production low, gets pushed out the longer we remain in an inverted yield curve situation. So the Fed could look at all this data that I just rattled off to you and say, okay, things are slowing down. We see it. Let's just hold pat until November and then make a call then. Or they're going to look at housing and say, it's already coming back. The consumer can take another increase in interest rates, and that would mean in mortgage rates. And we really are concerned about inflation. That's what they would say to themselves and to the world. I think we should plan on another 25 basis points in the between now and the end of this year. And then they'll probably stand pat, and maybe by March, April, they'll begin to ease up on that interest rate trend. Money supply is still in a negative situation, so that's telling us that overall monetary policy is still seeking to drag down the economy. This is not the normal thing we talk about for our Fed Watch, but if you want an example of what's going on, look at the S&P 500 and what it's done since October 2022. Profitability isn't moving up, but the market is moving up. It is very bizarre. And if housing is a Class C leading indicator, my experience over 40 years is that the stock market is a Class D leading indicator. It's not one that we lean on heavily, but it is a very obvious one, and the market can afford to be wrong longer than I can afford to be right. So there's no point in fighting that. There's no point in fighting the Fed. What we can do is focus on our businesses. And we're continuing to encourage you, automate, 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 and take market share. If your business is positioned in a place where you're not really a contender for market share, then your margins probably aren't going to be there. And maybe you think about putting those resources in markets that are growing. Alan and I talked about some that tend to be recession-proof or at least asynchronous with the overall macroeconomy at our July Depression webinar. And so for those of you who watched that, you got those slides, you got the recording. I refer back to that for some relatively safe havens that you can look for over the course of 24 and probably 2025, at least the beginning of 2025. It's a whole lot of, man, we missed the days of clarity, and we haven't had clarity out of the leading indicators for about 12 months now. That will resolve itself, but right now we're just trying to balance out the slides with the green shoots and figure out what it means. And just to close this up, we think it means there's another 25 basis point hike coming, and don't be surprised. Just understand what it's going to mean to your marketplace and therefore for your business. Thank you for joining me for this edition of Fed Watch. I look forward to seeing you next week.